He's Agora Hills.
He's American. He's American Jew. Maybe.
Exactly. Yeah.
All right.
Yeah, I was actually born in Afula myself.
Oh yeah. Okay. Well, I was born and raised in Jerusalem. I came here when I was 14, so it's up until not too long ago it was exactly half, but now it's been here much longer. Emil, you and I actually coincidentally were in a transaction. I purchased the Mountain Drive property a few years back from you in San Bernardino.
Oh, Anna worked for you then?
Anya
Garbawi. She worked for you for a bit. So you bought the 4120 from me. So I spoke to you before.
Correct. And we still have it. Yeah.
Small world. I love that property, actually. It's pretty cool. I like the bungalows.
It's a great property. Cash flow is really good. My partner and I were talking, should we look at selling? And I said, why? It's no headache. Rent's coming in.
Yeah, man. It's by the university. I mean, anything. We talked forever. You asked me, what do you think about this deal? I'm like, it's mine. It's self-serving. It's just too small for me. Exactly. He asked me, David. He asked me in a transaction. This is a couple years ago, right? 2, 3.
Yeah, about 2, maybe 2.5. Yeah.
Yeah. So he goes, well, what do you think of this deal? I'm like, you're asking the seller of the property? He's like, but you sound like an honest guy. I'm like, okay.
Sometimes you ask the question to hear the response, regardless of the answer. You know how to read between the lines. No, it's
a good property, man.
You called it as it was. It was perfect.
No, it's funny. Okay. I bought that thing for dirt cheap, but oh my goodness, the amount of remodeling we did with that thing, it was insane.
Yeah.
So,
we're actually considering. I think you can add another 4 or 5 units there. So we're looking at that option.
It wouldn't work.
I'm thinking of maybe we can even talk about this as one of the questions on the show. But thinking of maybe at least getting plans kind of drawn up, drafted, and maybe resell it as a opportunity for potential investor to come in. And
the difference is the financing, right? You're in the residential field, so you finance as a fourplex, and the rates are good. And the problem is that, let's say it's worth whatever, $70,000 a door, right? 280 or 300 or 400,000, whatever. And you double the density, and now you're at $1 million. You're still not going to get good financing from a commercial lender. The rates are going to be through the roof. So when I've done this analysis before, because it's got a lot of land, and I was thinking about doing that. But in this market, with where the costs are for construction, I don't think in that location, with the kind of rents you'll fetch, is going to be worth it. Now we're doing a deal right now in downtown that's going to be a modular build. We're actually building them out of containers. It's a company called Crate. So we're doing 20 little containers because the cost of building for units that you can only rent out very cheaply is not worth it. The numbers aren't going to pencil.
Is that similar to like the micro units? Are they like really small units?
They're decent. They're decent size. They're like studios that are well equipped. They're not micros, but they are modular units. So there's a company called Crate that takes little ship containers, and they chop them up and put them together. And from the outside, you can't really tell unless you want to expose the metal sheet, right? It's like a normal building, but it's way cheaper than doing ground up. So you build the foundation, you stack these units on top, and it works for low income, like kind of lower income housing.
Very nice. Very nice. Well, on that note, I'll go ahead and get us kicked off. We are streaming live. So thank you, everybody that's joining us here on Zoom, and everybody joining us on YouTube and Facebook. I'd like to welcome our special guest, Emil. Emil is the founder and owner of Forbix Financial, which is both residential and commercial lending. But I know Emil is also personally invested into commercial and real estate. So it'd be an interesting take today to find out. Most of our speakers come specifically from the real estate side, only doing real estate. So I would like to hear your take on the market and kind of where everything is going. But first of all, thank you for joining us, taking the time out of your day. And, let's get started with maybe your story, how you even got into this industry to begin with.
Sure. Well, first, thanks for having us. We do have, just to kind of make a correction about the company. So Forbix Financial, I'm one of the partners in the firm. It's a commercial mortgage bank. Forbix Capital is the arm that does the residential financing and private debt and mezz. And then we have other LLCs we set up for basically development and joint ventures that, long-term hold kind of strategies. And thanks for having us. And my story is pretty simple. I moved to LA in 2000 or 2001. And I started working initially the entertainment business. And I really didn't like it because I thought people were very two-faced and it wasn't my style. And I got out of it, and I was in stocks and bonds for like 6 months working for this gentleman that was a kind of a financial guru, had a newsletter and used to be on CNBC and all this stuff. And I felt like, oh, I'm going to go into the markets and make sense of it. And then I didn't really understand it. I don't understand why somebody would pay 20 times the value of a company and buy a stock. It never appealed to me. I never got it. And I figured that, hey, if all the people that I know that have any money eventually take their money and invest in a real estate, why don't I skip it and go into the real estate field right away? And so essentially, I answered an ad to be a receptionist at a mortgage company ran by who later became my partner. And I worked for her for about a year. And at that time, what happened is I was working as initially answering phones. Then I turned into like a pseudo processor. I started bringing some technology to her because she was a little bit obsolete and very old school. But at that time, she was already in business for over 20 years. So she would teach me the business side. I would teach her the tech side. And eventually, she got a little bit sick, and she thought maybe she had cancer or something like that. And she was going to kind of shut down, and she was trying to get treatment. And my wife said, hey, well, how hard is her job? I said, it's not so hard. She goes, well, maybe you can just do it. I'm like, maybe I can. So I talked to Nahid, and I said, Nahid, listen, go to Australia, go be with your sister, do your thing. Let me run the company for, 3-4 months. Let's see what happens. I was 20. And for some reason, she said yes. Fast forward like 5-6 years later, she was like, yeah, you had that look in your eyes of confidence and just, you're going to get it done. And she said, what do I got to lose? I'm like, your license? I don't know. So long story short, she let me run the company for a few months. She gave me a few quick pointers. And this was before all of the regulation of how much you could charge and how you couldn't. And so she would tell me, hey, just make sure you charge $5,000 a file. So I do a loan for 100,000, I charge $5,000. I do a loan for 2 million, I charge $5,000. So somebody got a great deal, somebody not so great. But that's how ultimately I started with her. Fast forward, she came back 3 months later. There was a bunch of money in the bank account. I kept myself my $12 an hour salary and the bonuses, and she was happy. And then we had to sit down, and she goes, listen, if you want, you're a good guy, why don't you buy into the company? I said, sure. So for 10 years, we were partners, and I earned my way into a bigger share of the business. And I lasted with her until 2011. And this is, after the crash, her and I were still working together, but I kind of needed to take it to the next level. And I felt like she wasn't going to be working for as hard as I would be at the time. And she also, right, I didn't think wanted to do the mortgage banking side and do all the things that I had aspirations to do. We were at different cycles in our career. And I went on my own in 2011. Initially opened Forbix Capital, and then my at the time client who I financed some properties for, residential and commercial, Ron, he came, and he has a big market maker background on Wall Street for many years, really smart guy. And he came to me and he goes, why don't we create a mortgage bank that's a commercial mortgage bank? And I said, well, why not? So the rest is history. We started doing commercial debt, residential, private equity, and we started developing assets and buying non-performing debt, repositioning. And so that's my story.
So what was the deciding factor on going more focused into commercial as opposed to residential?
I get bored easily, and I just got really bored with residential lending, but that was 2 or 3 years into my career. And then I started doing commercial at the time in my previous partnership. And it's a little bit more complex. I like structuring deals. That led me to investing in projects. I looked at what other people were doing and took the things that made sense to me. In my heart, I'm still a lender that invests in projects with a lender type mentality, where I care more about the downside risk of what can happen, and I'm not trying to kill it in every deal. So a lot of our deals are structured where we make a certain amount of money first as a preferred rate of return, and then an equitable split, whereas our partners can make a lot more money than us if the projects go great. But at the end of the day, my goal is, slow and steady win the race, and we're not in a hurry, ever.
Okay, very nice. So you obviously have a very successful operation. You have a large team with you. How did you guys adjust, or what type of adjustments did you make back in March when they all of a sudden notified everybody we're going to shut down?
We didn't do anything. So in March, it was kind of like, what's going to happen next? So we have a bunch of loans on the books that we're managing, servicing, as well as new loans we were going to make at the time. And I thought it was another 2009. So it's kind of like duck cover hold. Let's see what happens next. And March was dead. We were trying to we were trying to figure out what the rules were. So especially for the assets we manage and own, you can't evict. People don't have to pay you. They have time to pay you back. So we really were trying to figure out where we will need to plug the holes from an investment perspective, and as well as who's going to be not paying us in the next 30 to 60 days so we can protect our investments. From a lending standpoint, and my team, I have probably, I think 35 people, which is our team. Everybody stayed on board. Not one person was fired. We said, hey, we can last for a few months until we see what happens next. And as most of you know, March was dead, April deader, and then in May, it went crazy.
So then, did you make any operational adjustments with how people interact with the customers? I guess one of the biggest questions is, when we didn't know what was going to happen, everybody went into lockdown mode. We worked from home. We made the adjustments as best as possible. But did you change anything with how you guys interacted with the consumers? And were you surprised with any of the response and potentially any of it really help you?
We converted. We stopped a month before everybody else shut down. So I kind of saw the writing on the wall in February. And in early March, we were all home. I made sure everybody had a station at home. I was prepared for what was going to be next because, you're looking at the market. If something happens in Europe, that eventually it's going to happen here. It wasn't very complex to understand. And so even now, we're not really coming to the office. Most of my staff, for safety reasons, is working from home. And frankly, I had to change my way of thinking. Because I used to think old school. I walk through my office, I see everybody in their little stations. I know they're working. No, I don't. I don't know what they're doing behind their desk. Unless I stand over them and look, I can't tell. So it was it's a kind of one of those simple self-realization of I don't really control that. So their production is valued based on how productive they are, whether they're home or not. And then I started reading and I realized Microsoft has 50% of their employees working from home. So those guys are doing pretty well, So I figured it wasn't that important to have an office space. And I think it definitely will change the dynamic of how people think about their office space. I still think sometimes in a closing, it's convenient to have 2 or 3 people around you as more efficient. But just case in point, we're doing this on Zoom, and my son's doing his school on Zoom, and we've had quite a lot of meetings. Like David and I have been on plenty of conference calls with realtors and different events where you don't have to drive anywhere to be on a call. And I might be wearing pajamas underneath this jacket. You would never tell. It's amazing. I feel like a newscaster.
So now if everything, went back to normal, do you enjoy the new way of doing business? Or do you see yourself kind of sticking to this, maybe making some minor adjustments, or are you waiting for the days where you can bring everybody back into an office?
I think it'll be different. I think and I said this month too, I started walking 20 miles a day. I started bike riding in the mornings. And so everything changed. Right. And what I realized, I don't have to be from 9 to 6 or 9 to 7 in the office. I could be in the office when I need to be in the office. And when I don't, I can work from my cell phone. Even though I felt like I was pretty technologically savvy, I wasn't using half of my tools. And I think we could definitely be more efficient by having, the VPNs and having the proper syncing and the proper, different flows in different systems. I intend to give up the space probably in the near future when the lease is up and lease something that's going to be a little bit more creative, where it's a place for people to gather and come and have meetings, etc. But if they have strong and good stations at home and they can be efficient at home, there's absolutely no reason for everybody to be in the office. I think it'll be a much more fluid environment going forward.
Right, absolutely. So, I ask this question a lot, and a lot of people are very careful on how they answer it. So I do want to preface it by saying nobody knows what's going to happen. Obviously, everybody has their own personal opinion. So my question to you is more your personal opinion. Where do you see the market, specifically with commercial? Because we know in lending, it starts with commercial typically, and then it starts going down line and affecting residential eventually. But where do you see the market in the next 6 to 10 months or so?
Okay. I'm not shy about answering tough questions, so I'll give you my point of view, and I'm pretty opinionated. I don't think it starts with the commercial markets. It starts with a stock market. There's a wealth effect. So what typically happens is when people see their, savings drop because they have, $2 million in a stock brokerage account, now it's $1 million, that creates a panic. Also, the credit becomes to tighten. And when the credit tightens, it doesn't only tighten on the real estate side, it starts with the business loans. When I say business loans, I mean corporate loans, So the overnight paper. So there's a lot of things that start in the market, then go into commercial real estate, because in essence, commercial investors are typically more sophisticated than residential investors, if you're talking about from the commercial standpoint. And then it kind of hits the street. My point of view is that in the last 6 months, the government injected trillions of dollars into the economy. That money, like water, has to go somewhere. You know how you have a water leak? And eventually it trickles and trickles and it has to go through, and then it becomes a flood. Yeah. Well, I mean, people were concerned about, hey, what's going to happen after the elections? I predicted that the market would, if Biden would win, then the market would drop for a few months and then skyrocket, just because there's a lot of liquidity in the marketplace. I thought if Trump would win, it would skyrocket as well. Well, Biden won and it skyrocketed anyway. So the point is that I think there's so much money in the street, it has to go somewhere. I don't see us going into a recession next 12 months, as long as obviously we reopen and people continue to invest. But certain sectors are never going to be the same. I mean, I think the hotel industry, the office industry, much like the first questions you asked me, are going to change. I don't mean hotels that are resorty. People will eventually start traveling and staying in resorts, et cetera. But I mean that Motel 6, where business people come in and stay there for a day and then fly back. Airline industry, hotel industry, office industry, I think they need to reinvent themselves. And I think there's going to be a lot more deals for people that are developing to do adaptive reuse. We've done that a few times where we bought an office building, converted it into apartments and commercial, and repositioned it. So I think there'll be opportunities from that standpoint. I don't think the market's tanking in the next 12 months, Lyra.
Okay, well, that's a good outlook. Well, how do you then, on the flip side of it, feel, because a lot of people are going to be affected in their qualifying, right? The market might not tank, like you said, and there's going to be more money available to invest. But also it seems that a lot of people won't qualify as easily if they've enjoyed some of these benefits, forbearance and other things. And I believe that there's probably going to be some adjustments with the ruling behind it. Mm-hmm. But how do you see lenders treating, certain sectors like retail moving forward? And are they going to become more strict? Are they going to eventually loosen back up a little bit? Mm-hmm. What are your thoughts on that?
That's that's a little bit more of a loaded question, because there's different types of retail. There's different types of commercial. We've had a lot of conversations in April and May where clients would call us and say, hey, I was offered this forbearance agreement. What should I do? And it doesn't matter, residential or commercial. The outcome is the same. Just typically commercial doesn't report to the credit report, so it's not a net effect immediately. But for some people that enter into a forbearance agreement, having judged it from the last cycle when they were doing that, even if they made their payments on time and weren't really 30 days late, if there was a modification, it would be noted on the credit report and drag the score down. A lot of clients were not aware of that. And some clients just realistically were trying to take advantage. And I told them, if you absolutely need it because you really can't make the payment, do it. Because what is a forbearance really? A forbearance is you're going to repay this money sometime in the future. And if you've got the money, pay it. If you don't, then you have no choice. Then you're going to deal with the consequences.
Right.
Exactly. So, but I think in reality, what's happened is let's talk about on the residential side. They have certain guidelines that are specific, and each lender is a little different, that we're okay with forbearance. There's going to be some lenders that won't be. But for every product, as you know, being in the residential business, there's a lot of type of products. Yeah, they're not going to get a 2.5% 30-year fixed, but there's plenty of other lenders out there that are perfectly fine lending you at a higher interest rate and still letting you qualify. There's a lot of products in the street, and the market at the time when COVID hit slowed down with all of the non-QM products on the residential side, but then reopened up again around September, and all the same players were out to play and the people were buying those securities. So there's a difference between bank financing and securitizations. So a lot of the CMBS pools, commercial mortgage-backed securities, the type of loans that were done for office buildings, large retail, et cetera, those are market driven. So when the market stopped funding them, they're in the same bucket as the non-QM ones, the ones that you guys use for stated income. And because of that reason, there was kind of a freeze. But now everything's reopened. People are still lending money, just won't get as cheap of a rate.
Right. Okay. Very good. So when I know you're also an investor yourself, when you're given a deal, and we can run some examples here shortly, but when you're given a deal, what are the let's consider maybe like a residential development opportunity, right? What are some of the first things that you analyze very quickly to determine if you should even invest more time, or this one is not really going to pan out? Are there,
as an investor or as a lender?
As an investor.
As an investor. Location first, right? And typically I get into partnerships. So I think it's the strength of my partner and their experience, whether they have built properties of similar type before, because that's the most important part. Number one is location and whether there's enough skin in the game from my partner. And two, whether there's enough profit to make a deal work. And how much is saturated on that street. I'll give you a case in point. We live in Los Angeles for a property that's, let's say, in Hollywood Hills. It's all about location. There's 20 cliffhangers right now in the market for $15 million, and none of them can sell because they're overbuilt. But for a unique location that has a private access, driveway, et cetera, on the right street, there's still buyers for it. And for the right product, the right price, they sell. So I think it just has to do with what it is. If you would come to me and say, hey, we're doing a single family development in Encino, and our cost is going to be $1 million and we're going to resell it for 1.3, leaves very little margin for imagination, and we pass.
So do you have maybe any tips, because we have a lot of realtors that watch this show? Do you have any tips for realtors on over the next 3 to 6 months, if they were to start focusing on a segment of the market, whether it's commercial or developers or just stick to residential type clients? Is there anything that you feel they would have a little bit more of an advantage if they focused in that segment?
I think it's one of those things where it depends who your competition is. If you have a person that's passionate about something, they should do whatever they want. Because in my opinion, if you're passionate about doing commercial or residential, you should stick with that. So it's like I could tell you, hey, focus on selling newspapers outside, but if you don't know how to do it, you're not going to succeed. And I think whoever's a commercial realtor and is going to get into residential, different type of mindset, different type of clientele. I think for me, and I say this to my team, you got to do what you're good at. You have to understand who your audience is and focus on that. Now, within that parameter, I think we all have to be pretty fluid, right? So us, for example, we have a commercial, residential, investment. So sometimes one department's slow, the other's busy, and so forth. But you can't make a residential realtor into a commercial realtor overnight. They might not have the audience for it, and they don't know how to analyze those deals.
Right. And what about rates? Where do you think rates are going to be over the next year?
They're going to stay flat. I mean, I think the Feds came out and basically openly said, hey, for the next couple of years, we're going to leave the rates flat. And again, we're talking short-term rates. They continue to buy, the bonds to keep the long-term rates low. And because they've already kind of set the precedent for them to come out and say, hey, we're going to increase the rates, that will destroy the market. And they're not going to do that yet. They also moved the inflation index slightly, which is a little bit scary because, they basically, hey, we're not going to increase rates, but we know that's going to cause inflation. So they moved the little inflation meter a little bit and saying that, hey, even if the inflation's a little higher than what we're used to, we're not going to increase rates. And that's the one thing that can create serious crashes. So everybody's kind of kicking the can down the road. I know we're in a strange time given the pandemic and what's going on in the market. So you probably have no choice. But I think that the bigger the bubble you make and kicking the can down the line, the bigger the eventual crash. And I think the next one's going to be caused by rate increases eventually when inflation happens. There is no other way but to increase rates. And I think that's what's going to create the high unemployment and the eventual crash. And as advice, save your cash, put on the sidelines as much as you can. Wherever your rents are, refinance, recapitalize into lower interest rates at a long term, and sit on the properties for a while. That's it. So
what's your favorite type of deal? Either from a lending or from an investment side, when deals come to you, what turns you on more in terms of real estate?
Very, very interesting question. I like the structured deals, right? So that's what I get excited about. Kind of figuring out a way to make a partnership work or put the pieces together. From where we sit, we're mostly multifamily. That's my bread and butter because it's easy to understand. I mean, we mostly invested in multifamily for the last 20 years because I always felt it was an easy asset class to understand. And there's a lot of people that make money in retail and industrial. And I financed all those projects before. I just don't really know the tenants and the structures, et cetera, et cetera. So I, focused on multifamily. Now we're like, oh, wow, you guys are so smart. Not really. I just was practical because I knew that worst case scenario, you put an ad on Zillow or apartments.com, a tenant will come. A little higher, a little less, but you'll get your tenant. And so for us, multifamily is one of the most popular sectors for all investors. We were in it, for a long time, and we continue to be in it. And if before we used to, buy properties and rehab them and reposition them, there haven't been great deals. So we started doing different partnerships with ground up developments. And then eventually, you build it, then you refinance, recapitalize, put in long-term money, and you hold on to it. So.
Okay, we do have a question here that came in. What type of technology do you use, or what kind of social media do you use to recruit new agents into your company?
A lot of the people that have worked with us have worked with us for a long time, and it's always been people we actually either done business with or different lenders in different banks, or people that came as a referral from somebody else that worked here. And so a lot of the people in my office I've known for 10 years or longer, some almost 20. And so it's a pretty tight-knit family. But if you can, if it's, somebody and, we hit eye to eye, because I think in this business, it's all about relationships and personalities. And you can have the best top producing person, but if they don't fit the dynamic of our office, they won't work. We're pretty easygoing when it comes to our style. We're serious about what we do, and we do a lot of volume. So we don't have a social media platform. We barely have a website, frankly. You know what I mean? We don't advertise much. It's been a lot of word of mouth. A lot of our team are at conventions. I mean, I know David has a Facebook page, and a lot of people love it because he posts pictures of his adorable daughter. Aside from that, we don't really do much advertising. Oh, we're on the Persian radio. We have one of our people, Fariba, that I've known for almost 20 years. She advertised on the Persian radio, mostly for her, for the commercial. But aside from that, we don't do much advertising.
All right, good. If anybody else, by the way, has any questions, feel free to either drop them in the comments, or I know Tal is monitoring that, so just keep sending them my way. I thought it would be fun to maybe run a scenario, right? I have several scenarios that I'm either involved in or that are brought to my table. So I wanted to run a commercial deal by you and see how you would analyze it, and if you think this is something that is lendable or you would even potentially invest in, right?
I'm ready.
I see. Okay, so property was purchased a year and a half ago. It's a strip mall in Elyria, Ohio. It's about 30 minutes outside of Cleveland. It has the anchor tenant as Dollar General, so one of the largest dollar stores in America. They just renewed a few months ago their lease and extended for an additional 5 years. Property net operating income is about $225,000. The purchase price was $1.4 million. The current debt on it is about $1,060,000. Very conservative valuation, I would say 1.8, 1.9. Probably higher if you looked at a cap rate. I would say maybe 2.2 at a 10% cap rate, considering net operating of 220. Still has about 20% vacancy, so still room for upside. What other important questions from an underwriting perspective do you have?
Who are the other tenants besides Dollar General?
There is a restaurant that's been there for 30 years. There is a Sally's Beauty, which is a small franchise for beauty supplies. There is a karate studio. The county of Elyria has an office there for, I think, something for moms, but it's a county office. I don't know the rest of them, but I think.
How long has Dollar General been there?
Dollar General has been there going on 8 years, I believe.
Okay. So
Yeah.
I think you got to look at the financials of this particular deal, because we know as a retail customer, Dollar General probably continue to pay because they're strong and they have a good corporate lease. You got to see if the other tenants were paying. I doubt the beauty salon paid. They're probably in a forbearance.
Everyone's paying.
Everyone's paying?
Everyone is paying so far. Perfect. Nobody has missed a payment. 2 tenants just started 2 months ago. And so far they're in, actually, I'm sorry, 1 month ago, 2 new tenants.
And when your client bought the property for $1.4 million, was it at the time where Dollar General didn't sign the lease yet? How come he got such a good deal?
First of all, it was an auction. Secondly, their lease was coming due. So I was part of the deal myself, but when he bought it, first thing he did is renegotiated the lease. Rent-A-Center was on the lease at the time, but they weren't in the building. They left but kept paying. Then there was a buyout negotiated, so they're paid for the next year in advance, but the space is available for leasing.
Got it. And did you put an additional money into the deal past the 1.4?
So they put the total invested was $380,000. That's why they owe about, I think, $1,060,000 now.
So there's no additional tenant improvements made, meaning you bought.
Yes, there's been tenant improvements about $50,000. The parking lot's been redone. The building has been repainted.
Got it.
Right now, the roof is being replaced.
Got it. Okay, so if that's the case, let's say you're into it or the client is into it for $1.5 million.
Okay.
1.5 million times 80% of cost, right? We're talking 800,000 and 4. So we're talking about 1.2. So the most you're going to get is 1.2 just based on a loan to cost. It was such a recent purchase, and there's a couple options. If I was the borrower, right, and I got such a screaming deal, because obviously at $225,000 net income, you're in a position where it's probably, I would guess, a 9 or a 10 cap, and it's worth at least 2.2. You can argue that it's more. I don't know that particular city in Ohio, but
that's why I said conservative 1.8.
Yeah.
That's at a 12 cap.
Let's call it 2, just for the sake of argument, right? If you're going to be at 60% of the value, which is 1.2 / 80% of cost, that's probably a reasonable deal to get done. You're not going to get major players involved because the loan is very small. So you're going to have like a regional bank or a smaller conduit that will do this deal. You're probably looking at mid-4s types of rates with a 20 or 25-year amortization. And that's going to be the deal.
Okay. And from an investment, would that be a deal that you would come in as a lender / partner if they were open to something like that?
No. It's in the middle of nowhere. It's a Dollar General with a lease term of 5 years. I've seen people have 10-year leases on Dollar Generals and they expire, they decide to move because that location didn't make as much money and you're stuck. If this was in like a prime MSA in a really, really strong market, different story, right? But if you're like a suburb somewhere and if this tenant leaves, you're done, which is the reason why the guy bought an auction. For me, I would get in and get the heck out of this deal as soon as possible. Have a regional local player buy it and call it a day.
Got it.
And it's too small. It's too big of a headache. So the most you're going to make on this deal ever is a couple $100,000 a year after financing. Let's say you borrow money at 1.2 at 5%, right? The basic math is $60,000 a year, right? So you're making great money. I'm not saying it's not great money, but it's just a matter of time before that tenant expires and something goes wrong, or people don't want to go to Dollar General anymore. They want to buy their stuff on Amazon.com, and it's a bust. So I would get in and get out of this deal as soon as possible.
Exactly what I did. But there's still the main investor involved, so we're going to help him with some financing. And
lenders that want to do those deals, and they understand that stuff, and they think that it's going to work, and based on amortization, it's going to keep paying itself down. And but not my bag of tea.
Okay, good to know. All right, so let's see. We do have another question through YouTube. The upcoming bubble bursting. Would you recommend to reduce leverage by increasing equity in properties? This is a question from Luis Cruz.
It depends on your rate. If you have free money, I would keep cash on the side, because I look at it this way. People say to me, hey, what should I put another $100,000 down and I'm going to save $300 a month? I'm like, let's calculate how long $300 a month will run you if you have $100,000 in your bank, right? I'd much rather have a better liquidity position and have more money in a bank account that I can invest or cover shortfalls in positions than dump more money into the property as equity. Now, if you're sitting on $1 billion, please pay everything off.
Okay, good answer. Emil, you have any deals that you want to pitch to the group, or any opportunities that are available by you or your teammates?
Not really. I mean, we are constantly in projects. I think it's just a matter of we always get rid of small stuff. Like I have a lot in Glendale that I haven't done anything with for a year. I think it's probably like 200,000 maybe. Somebody can build a great house for themselves and good location. I have another commercial property in Irwindale. It's on the website actually that I'm probably going to sell. Just haven't gotten around to it yet. Again, for me, I'm more of a multifamily person. We bought that one in a BK auction, put a lot of money improving it. But again, it's perfect play for an owner user. There's 2 warehouses there and somebody can lease the office space. So if I was in that business and if I was in that location, I'd probably buy it, live in it, call it a day. I have another one that another property we're selling and will be selling shortly in the next 6 months in Santa Monica, a 3,000 square foot office building. Other than that,
So you say, you like multifamily. You mentioned that a couple of times. Are you into finding the lot, doing all of the entitlements and developing it, or do you prefer to buy them ready, built, or do you prefer them RTI? What's your preference in that?
I'm not, again, we're not chasing deals. It's a good story and we like the location. So I'll give you the last 2 deals that we've done that are, we have a bunch of projects in Washington State. And usually those deals pencil pretty well, where you're building to a decent cap rate that when you're done, you can refinance, pull most of your money out and just sit on the properties for a while. And we like that market. It's got strong income. It's got, it's a market that doesn't do a lot of the ups and downs that, the Miami, the Arizonas, and New York, and the California does. But as a whole, for me, in general, it's location and story. So the last deal that we got into, well, the second to last deal, was a project in San Francisco where we actually partner up with a local community builder that had this property under contract for a very, very long time, but they needed the right capital partner to come in and buy it and make sense of it. So we bought a site in San Francisco, in Hunters Point. That's a project that's 224 units with 20,000 commercial, and they could be condos. You can hold them as apartments, or you could sell them as condos, and it's right on the water. It's a great location. We like the story. We like the whole community aspect of it, and we want to develop it. And we think that location is very much like our current Inglewood. There's going to be a lot of growth, and over the next 10 years, it's going to get better and better. So in that particular deal, the project was entitled for its use, but it's still, we're 2 years into getting the community approvals, and ultimately we probably won't break ground for another year, or close to a year of actually beginning the construction. The other deal we did was a repurposing of an existing commercial building in Inglewood. So we got into a partnership with also a local developer who really knows his stuff, is a really good guy. And we felt it was a good deal. And at that time, it was an office building. It wasn't entitled for the multifamily use, but I was comfortable with it because I knew that at the price that we got into the deal for, we could sell it as an office building or rehab it and keep it as an office building and still make money. But our intention was to repurpose it into mixed use, residential and commercial. And we ultimately got our entitlements in September, and we've already begun doing the demo work and going to do the full-blown construction and the rehab and the reglazing in the next 12 months. So it just depends. But am I looking to overpay for an RTI deal? No.
And nobody wants to overpay.
Nobody wants to. Yeah.
Definitely not Persians or Israelis.
or the hybrids like me, the Russians and the.
So let me ask you, because you mentioned repurposing a lot, and I think that is definitely something that's going to come up more and more. Do you see the rules and the regulations changing because of COVID or at all to allow to repurpose much more smoothly? Because it
depends on the purpose.
Okay.
Depends on the city. So for example, like if you're, I sit on a board of a nonprofit organization that manages thousands of units for low-income housing, mostly to get homeless people off the street. It's a company called Skidrow Housing Trust. And, that whole model is to create low-income housing across the country, and not country, really in downtown LA it began, but now they are branching off to other parts and throughout California, maybe even other states, to continue to do more of this And then whenever you have a low income housing aspect, you're doing tax credits and you're converting zoning, it's easier because you could fit into all the propositions where, there's a prop that was passed that's called, JJJ. If you transfer the zoning from a different use, you have to build prevailing wage. You also have to have a certain percentage of your housing to be low income housing or a BMR, below market rate. And each city, each county is very different. So for example, like in San Francisco, if you're a new developer coming in, you have to, irrelevant of the zoning, if you want to do multifamily, you're going to make your project between 15 to 30% affordable. In LA, just depends on the situation if you want density bonus. In Inglewood, the rules are different. But I think as a state mandate, because people want to provide more housing, more affordable housing in general, I think the rules will likely loosen up, but it's a highly bureaucratic process. So loosening up may take years, and by the time they loosen up, maybe you don't need it anymore. So I think, but I think just in general, if you have an old hotel, I see a lot of people repurposing them in other parts of the country. Like there's a few deals we're looking at in the Texas for financing where people are changing hotels into small apartments or an office building and repurposing it into another use. It's already happening.
Very nice. Okay, very good. Well, we are a little bit over our time, but it was a lot of useful information, so I'm sure it was worth it. And I do want to take this offline with both you and David because I have a couple of deals that I'm sure you guys can be a part of and help out on. So I do want to take the time and thank you for joining us and sharing and opening up, especially now as anybody in the lending business. There's barely any time in the day. So for you to go out of your way and do that is very much appreciated. So thank you for that.
Our pleasure.
I also want to thank everybody that's joining and watching on any one of the platforms. As usual, we'll be here next Thursday at 2 o'clock, same place, same time. So we look forward to having everybody back here again. Again, thank you very much, Emil. And we'll be talking offline.